Hello and welcome to the Harwood Report for September 10th, 2018. I am Keith Harwood, the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Make sure you read through the rest of these disclosures so that you are aware of what I'm talking about here. Give it a couple seconds. All right. Let's talk about the highlights. Equities are going to be the big highlight today, especially for the VIX. I think the VIX is an important indicator and an important potential trade coming up. Bonds and gold are in a little bit of a chop spot. I'll talk about what I'm looking for out of those before I get into a trade, and I'll talk a little bit more about oil because oil is actually setting up some interesting stuff and a little bit similar to the equity land. Of course, I like to start with fear and greed just to give myself an indication of where the market is pricing. Now, 55 is very neutral. What really is driving this to be neutral while the market's near highs? Well, we had a little pullback, so that helps make it a little more neutral. And then, frankly, it's the option stuff. The VIX is not as low as I would think it should be given where the market is. Most of the focus has been on hedging activity, given the put-call ratio. We're seeing more buyers of puts, and that's, I think, indicative of why we're seeing the VIX where it is. At some point, we tend to get back into that position where people buy right, so they start selling calls. That pushes the VIX down. That changes the put-call ratio again. That starts to shift a little bit of that sentiment towards greed. Right now, everybody's focused on getting their hedges on. What does that mean for the market? Well, it means that it's really tough for us to get a major pullback. Because if everybody's hedging, it means everybody has ammo on a pullback instead of everybody panic selling into a pullback. Now, that doesn't mean we can't with a fundamental input. Let's say things get really bad with China. I don't think those people that have ammo to buy are going to be really aggressively buying. But if things are just triggering off of little technical levels, say we get below the 20-day moving average or something like that, there should be aggressive buying below. So when there's technical drivers, I don't see us getting a washout the way that we did in, say, February, where some of this was technically driven, some of it was driven by the bond yield change, some of it was driven by where the VIX was. And part of that's because so many people were short the VIX at that time. Well, people just aren't nearly as short the VIX this time. People aren't nearly as unhedged long the market. People have protection on. It's smart in many ways to have that protection on, but it also prevents the market from really falling out of bed. So where do we go from here? Frankly, this is just setting up a little bull flag to me. Looks like we go right back up towards 292 in SPY. Okay, well, with vol high-ish, let's take a look at VIX to talk about that. Vol high-ish relative to where the market is. I mean, we're not seeing VIX down at 11 like we did even a month ago, or 9 like we did at the end of at the beginning of January and at the end of last year. Are we looking at a potential for the market to rally and call sellers to emerge? If so, what's the trade structure? I'll get you into the specifics in the premium newsletter. You guys can know where to sign up for that. I'll talk about it more at the end, but you're also on my site, so you can see the Harwood Report. The key here is, if that's going to happen, there's generally two structures I start looking at. That's either a call diagonal, where I'm buying something that, say, expires in 4 weeks, selling a further out of the money call expiring in 3 weeks, something like that. Or I look at a call butterfly. A simple call spread could also work, but I want to try to maximize my edge and maximize my leverage if I have a price target. So I'll talk through a little bit more of that in the actual newsletter. Just to give you guys a little balance, though, that's kind of my framework. I'm thinking we rally with the vol coming down. And potentially significantly so. We could see VIX down towards 11 or 12 as soon as maybe, the end of this week. If anything positive comes out of China, do you think that people aren't going to be excited to get rid of their put side premium? That might actually create that potential for a fall out of bed scenario if the market starts to pull back. But if anything positive comes out of China, I don't see the market having an aggressive need to buy more protection. They've got it. More likely to get rid of it than to add to it. That creates that VIX drop. Let's go to the Qs. So tech has been a little bit of the underperformer. Remember, the S&P stopped at the 20-day moving average. Qs got closer to the 50-day. That's been support, though, for a few months now. June and July. And August, we got close, but not quite to it. So September, we're doing the same thing. We got close, but not quite to it. Each time we do, Basically, we make a little bit of a new high. This time we got really close to a new high but it was a smaller pullback, and then we made the new high here. It seems to me like the general market flow is going to keep pressing these markets to new highs where there's dip buyers. So remember, everybody's long puts. We get dips. People are there to buy. That creates a little bit of buying pressure. That then adds to a little bit of the fear of missing out. Oh man, why didn't I buy the dip? We run a little bit more, get a little too frothy, get a little pullback, but everybody's got puts, so they're there to buy. So it just creates this chopping trend higher where we go up and a little down, up and a little down, up and a little down. And as long as there are people that are hedged, I think that has to continue. Again, barring a major fundamental update that's a problem. One of the sectors of components of the Qs that I always try to watch as a tech indicator, a bellwether for the tech sector, is SMH, the semiconductors. So these are the sort of the high flyers, the Nvidias, Microns, AMD, all these names that have just had these really sexy moves over the last year or so. Well, the thing is that this has been really just consolidating for, it's close to a year now. Really, from November, and it's a wide consolidation. We had chop, and then you can see that this is a tightening chop, though. So it goes up, then down, up, then down, up, then down, up, then down. It's not making that progress the way that we've seen in the tech sector or the S&P, where the chop has a bullish trend. This is chop that is just a tightening trend. We're creating a coil. This could be a really big signal for us if this coil eventually bursts and the sector either breaks out to the upside or breaks down to the downside. That could create a general big money flow situation for the overall market because this is such a indicator for a lot of people. So I got to watch this closely. Right now, that coil is not that tight. Basically the breakdown would be a move below 101, and the breakout might be above 111. So that's a decently wide market, 10%. But as this continues to tighten over the coming weeks or months, if it continues to do so, it could create that much more of an explosive situation. So it's something in the back of my mind, something I'm always watching, but I'm thinking that this coil may continue a little longer. So as we get towards 111, maybe even 112, that doesn't necessarily break us out of the coil. It does create a little bit of a bullish, backdrop and maybe a bullish mind frame for investors, especially if that kind of move happens with a China deal. If that happens with a China deal, I don't necessarily want to fade that move. But a move towards 111, 112 right now seems still like a potential fade until this coil gets a little tighter and we get a realized breakout. Let's do the small caps because small caps do tend to outperform when we're sort of at the end of a bull run, and they've been doing better than tech, but not necessarily better than S&Ps. Yes, they've had we've put January well into our rearview mirror here, 8% away or so, 6, 7, 8%, something in that range away. Frankly, it's a very similar setup to the S&Ps right here though. On the short term, we had a pullback to the 20-day moving average, setting up a little bit of a bull flag, where today we had a higher high and a higher low. If we get follow through tomorrow, that's going to start putting some money, I think, back into this sector as well as the overall market. So I think that that's all generally good. Dow Jones Industrial Average is the one that's supposed to get hurt the most if there are trade problems, and frankly, it's not getting any pullback here. Didn't even pull back to the 20-day moving average. It's basically sitting at the 10-day moving average. So I think that also tells us that maybe, just maybe, people aren't overly long these industrials anymore. Maybe they're a little bit too short them because this is still below the January highs. Reasonably well below, 2 to 3%. Again, trade deals tend to potentially be good for these industrials. That could spark the start of a more major Dow Jones Industrial Average rally. So anything I think that happens out of trade, I think that there's enough fear in this market right now and enough hedging going on in the market and enough people trying to avoid a potential catastrophe a la what happened in February in case the trade deals go awry, that maybe this market's really just setting up for that explosion higher. First things first, I think we got to complete those bull flags in SPY and IWM and get back towards recent highs, and then we start to see how the rest of the world is going to play out with the money flow. All right. So I talked a little bit about the framework there. Again, if you want the options setups, take a look at the newsletter because that's where you're really going to get that. This is just going to give you kind of a mind frame. And then the option setup is where I get my leverage. So I get my setup here, and I could try to make 2% in the equity, but I'd much rather try to make an options trade that's going to triple or quadruple into that kind of setup once I've got my framework here. TLT is a bit unclear to me here. So I've been, initially kind of targeting a move back down towards 118. We're starting to chop a little bit in this 119 in the quarter-ish range, 119 and a half, 119. Maybe that's the extent of this move down. The 118 level was kind of driven by the February, March, again May, and then the low in July, August 1st, I guess it is technically. Maybe this is it for the move. Maybe it's not. For me, this is kind of a no trade right now, and I'm going to show you why. Because in the options landscape, I'd be looking for this. If I could buy vol down here at 8%, I mean, we got that low down just at 8%. That was incredible. Even 8.25% is really good. But frankly, this has been such a tight trade where like 8.8, 9%, maybe 9.5 is about as high as it's been getting. And it's getting down to 8.25. So right now we're just in the midpoint. So we've got a midpoint vol with a midpoint unclear direction in the ETF. Is there a trade there? I mean, I don't see a big edge to being short premium because I don't see a reason why we have to sit at 119.25. I don't see a big edge to being long premium because it's not that cheap, and I don't know that we have to immediately move to 121 or down to 118. So this is a spot where I like to sit on the sidelines. Remember, as traders, we have a choice. We don't have to take a trade. When I was a market maker on the CBOE floor, somebody comes up and they want to buy options from me, I have to give them a price. For me, I don't have a price that I'm particularly interested in buying calls, buying puts, buying call spreads, or anything else here in TLT right now. So one possible trade option for me in TLT is to not trade it. And that's how I'm going to start off this week. Maybe by Wednesday, I'll have a clearer picture from the technicals here. But today, I don't see it. If you see something, more power to you. But right now, with where options being relatively fairly priced on a historical basis and the ETF not having a clear signal, I don't see a point. We'll go to gold. It's going to be kind of a similar story to what I just said here. So you can see that we're kind of getting this consolidation right around 113. The dollar yen is chopping. It's right here in this middle of this range. So I don't have a clear signal at dollar yen, other than maybe that it's going to hold here because we had this it hold at the 100-day moving average. I mean, okay. For now, it's holding the 100-day moving average. It was using the 50-day before. Then it retested the 100-day. If that breaks, then we're going to retest the 200, which is not upward sloping. So maybe that creates a little bit more pressure on dollar yen. A lot of this is going to come through, I think, with fundamental updates, though. So rather than trying to fight for a fundamental for a trend in dollar yen that's not there, maybe I sit on the sidelines. And if there's no trend in dollar yen, there doesn't have to be a move in gold. The gold miners are at the lows. Somebody's just getting out right now. I think he's probably pretty close to done. But at the end of the day, I don't have an edge getting along this stuff because the vol is so high in the miners. Let me show you where it is on the juniors. So this is on a 6-month basis. Keep that in mind. It's at the highs, highs we've seen in the last 6 months, with the lows being about almost 10% lower in the vol. If I go to 2 years, you're going to tell me that this isn't all that high. And I would agree with you. But generally speaking, gold and gold miner vol goes up when gold and gold miners are rallying. That's not the case right now. So if we get a bounce in the gold miners, I think vol is going to come down. I don't know if we're going to get that bounce immediately. If there was a trade, maybe it's a short put spread. That's not a very leveraged trade. That has some serious risks if the market washes out. So, for me, the miners are a trade that I would rather wait, see if we can get a bounce, or see if we can get this vol lower, and then go for something with leverage. And silver is basically the same as those two as well. So you see that we've had this big washout. The volatility there is just not incredibly cheap yet. I think that what we could potentially see is a move back towards 14, vol come off on the move towards 14, and then if we go through 14, the vol could start coming back up again. But beyond that, there's just not much here. Where there might be something is oil. So let's take a look at USO. You look at this chart and there's a lot of chop, right? It's the same thing. We're back in this consolidation sort of area we had in August. But this looks a little bit like the equities market in that we're starting to see that bull flag. So you see the pullback today is the higher high and higher low. It has pulled back a little bit from the session highs to actually go red on the day. That's a bit of a concern for the bull flag bet. But if it confirms, if tomorrow we get another higher high and a higher low, we're going to be starting to cross some moving averages. And we found that support here at the 100-day moving average. Let's get above the 50, the 20, and then the 10. And then that could create some tailwinds for XLE. So XLE would then potentially just get right back up into that consolidation area where it was the last time oil was here. So $76 is $3 away. That's 4%. If we just get oil money flow justified based upon where oil is today, then the ETF could potentially pick up some of that money flow, especially as the market on the whole is rallying, and press this right back to 76, maybe even a little higher. Finally, we go to OIH, and this is the one where I think there's some real leverage here, because where we were last time oil was here was closer to 26. So you think about how much of a difference that is for this. So XLE, I'm talking about a 3%, 4%, something like that move. OIH has a potential for almost a $3 move. So what's that, like 13%? So for 13% in OIH, you look at the vol, it's a little bit expensive, not incredibly expensive. But if we could get a quick move in oil, I think we could get a really big move in OIH. That's where leverage can be found, even with the vol a little bit high. So watch for the signals there. The options trade I'm watching there is outlined in the newsletter as well, because that's where I think that there could be some real money made. It's about balancing the probability with the leverage when I see a setup like that. So now you can go to the newsletter right now, sign up for the Harwood Report. You get, the free one of the video anybody can have. But the newsletter itself that was posted this morning walked through all of these ideas and more, talked through the actual trade setups that I'm looking at. And then I do another Wednesday update where I update on the ideas that I'm looking at and how my opinions have changed for the market. On top of that, it's free for the first week. Okay, so you sign up, you take a look at the newsletter. If that adds incremental value to you, you say, well, why wouldn't I continue to pay $49 a month? Because $49 a month is almost, it's nothing in the marketplace. But most importantly, you get that first week for free. So if you get a week for free, I like free stuff. I'm trying to give you something free so that you can recognize the value, so that we can then move forward and build our relationship. So take a look at that, get some incremental knowledge, hopefully, and if you like what you see, stay on. If you don't, it's fine with me. We can have a conversation about why it didn't necessarily add value to you, or you can just move on without me. But I think you're going to get the value. Go to tradeacademy.co/Harwood Report to find that value for free. And let's build a relationship. You can email me, keith@tradeacademy.co with questions. That's the easiest way to get a hold of me. But you can also call me, 312-600-8004. Thanks again, folks, and have a wonderful afternoon.